A lot of them also are taking on more of a secondary approach. People looked at some of the success of the zero interest rate policy. Some people can play it, but not everybody can play it, especially if you're a lead VC. I think secondary still is a pretty strong signal that you don't believe in a company. So it's difficult in general for a lead VC to do that. We're seeing all the proliferation of party rounds, a lot of small funds banding together.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave. Did you know that you can get a free business class trip to Japan every year with Haymax AI? Haymax is a rewards app where 500 brands like Apple, Shopee, Amazon, Agoda, and even banks reward you for your loyalty by contributing towards your dream vacation. Through the Haymax app, every transaction you make earns you Max Miles, which you can redeem for free travel at more than 25 airline and hotel partners. Sign up at haymax.ai now to get a 1,000 Max Miles head start. Turn your daily transactions into dream vacations. Your business can also leverage the highly cost-efficient and desirable loyalty currency called Max Miles that has no expiry, no fees, and instantly one-to-one transferable to 24 airlines and hotels to acquire new customers and drive repeat sales with no integration required. Reach out to Joe at haymax.ai and mention Brave to uplevel your rewards game and reduce your cost.
Hey, Adriel.
Great to be on the 8 a.m. breakfast show again with you, Jeremy.
No, right? Always nice to kind of like hang out and chit chat. So it looks like our last episode that we recorded 2-3 months ago was quite popular. A lot of listeners sent in feedback saying that they enjoyed themselves. One person actually laughed about how brutal our take was on the region. And I'm like, it wasn't brutal, but I think that's how she kind of described it. How about you? What are your thoughts about people telling you about the episode?
Yeah, no, I think that episode definitely struck a nerve with a lot of friends, and I've had many follow-up conversations on similar bearish notes. I mean, I was just in Vietnam for Tech in Asia last week and have had similar conversations with both some of the local and regional investors on how they feel about the market. And some of them are actively thinking about, okay, how do you adapt fund strategy, investment strategy according to the realities of this market. And I think we've also seen some people do interesting investments over the last 6 to 12 months that I think are worth unpacking to some extent.
And I think that what's interesting is that I don't feel like we were being bearish. I think we were just being realistic. One man's realist is another person's bear, I guess. So I didn't feel like we had any like negative intention. I mean, also we are investing, and still investing in Southeast Asia. It's just that I think we have to invest in what's in front of us. Not really this amazing magazine cover, rah. And I think when we released that episode, I wouldn't even say that we were early in describing it. Like all that conversation was already happening over poker or dinner or in investment committee. It's just that I think it didn't really break out into the broader public, I don't know what's what, tech landscape awareness, right? And so I think my reflection on that is that I was surprised by how many people felt like it was being totally set fresh. Whereas to me, it was like, I felt like we had been talking about this for already 6 months. So I guess there is a time lag. Obviously, information takes time to transmit. And also maybe there's also some opacity in the ecosystem as well.
Yep, totally. Maybe we should jump right in and talk about the extension to that episode. So we recognize there are certain down arrows for the ecosystem and certain harsh realities we all need to confront. So what's next, right? I think there's a Tech in Asia report that generated some internal conversation. Talk through some of those.
I have it on the phone here, flash up. So I felt Terrence, the editor-in-chief of Tech in Asia, he wrote this letter and he took a screenshot which was being reshared across the VCs, which kind of confirmed what we were saying, but maybe more quantitatively. So basically, he was saying that the median distribution to paid-in capital for VC growth funds. This is a nice way of saying how much money did VCs actually make for people who invested in those VC funds. And so he was saying that for the fund age of 8 to 10 years, so the vintage was about 2013 to 2015, the US distributed 1x, Europe distributed 0.7x, India returned 1.3x, China returned 0.6x, and Southeast Asia returned 0.4x. So this nice way of saying that if you put $1 into Indian VC fund, in 8 years you already got $1.30 back. And maybe there's another few more years, 2 years, maybe the funds get extended, maybe then 5 more years. But there's more upside, you already made money, right? Whereas US is probably widely considered to be best in class. This is obviously the average. So when I look at this report, this was pulling from the Bain report. Obviously, this is the average distribution. So I think that if we probably looked at the first quartile, then this probably gets sharpened even more. I'll probably say that the US is probably still the highest performing for the first quartile performers. Because again, this is the average, right? The 50%. And then 2 is, yeah, I do feel and agree that India felt like a contrarian bet maybe 8 to 10 years ago. I think people were not very bullish on India. But now India is a great stock exchange. The political stability or the economic growth rate of the entire country has been quite consistent. And then foreign inflows of cash have consistently flowed in. Whereas for China, all the dollar funds have been decoupled. And so it's hard for them to pull in a lot of the growth capital. So you can see some of the bearishness there. But anyway, this is a lot of nice words talking about how good other ecosystems are. And probably a question is like, this does feel bearish about Southeast Asia. What are your thoughts?
Yeah, so I guess there's a few ways to unpack it. I think obviously in venture, we will talk about how vintage is very important. And you, in that Tech in Asia chart, you see that, I guess, across the 2 vintages, the earlier vintage performed much better. And I guess 10 years ago, that was probably when your Carousel, Shopback, Grab, Gojek, Tokopedia, and all that was started. And then some of those returns have been realized over time with some of the global growth funds coming in and buying positions out, or people trading out secondaries pre-IPO and even selling post-IPO. Whereas I think the later vintage probably still has some time to mature, but I think they have also bumped into a speed bump with the last 2 years of macroeconomic environment being not as bullish because of interest rates. Obviously, there's also the geopolitical tensions between US, China, and then within each local Southeast Asian country, there is also certain political and economic downturns, right? I mean, Vietnam, for instance, is going through a rough patch in both its political ecosystem with the changing of guards, but also I think from a real estate perspective, it's also suffering quite a fair bit, which is critical for Vietnamese people who have actually a lot of wealth tied up in real estate. So then you see knock-on effects in decreased consumption spending. And you don't just hear it from the people who are selling software, edutech, but you also hear it from the people selling consumer, F&B, etc., that people's consumption spending have easily dropped like 20-30% over that last 1 year. So added bearishness, but I guess where are the bright spots, right? I guess some people joke that, okay, Southeast Asia is not good, so let's run off to India, Australia, New Zealand, which is what some of our friends have started doing, exploring new markets. What are your thoughts on that, actually?
Yeah, I mean, that brings back the point, which is that the chart that we just mentioned is the past vintage, right? So 2013, 2015. So I think what people are saying is today is different. Today's vintage of companies being invested in has upside. So I think let's discuss that, which is where's the optimism. First of all is if you're a pessimist, or at least, again, not pessimist, but if you're looking at it based on historical data, I think, like I said, there are actually many Southeast Asians, especially in Singapore, who are covering geographies outside Singapore. So I think those with exposure to India, for example, they're spending a lot of time in India. And I think for them, word on the street is that they are generally more positive and more bullish on the India market for all the mentions that we mentioned earlier. I think we also see a lot of, I'll say, generally Singapore-based or even US educated. I think there's some overlap there. But a lot of those investors are covering, like you said, Australia, New Zealand, also the US, Europe. They're servicing or based in Singapore, and they have coverage, maybe 10-20% of the Southeast Asia market in case something is interesting happening. But they're off hunting deals outside Southeast Asia. I think that's one adaptation people are having. I think the other adaptation is people are moving earlier upstream. So they don't believe that in Series A or Series B, or at least it tends to get competed away pretty fast. So they're trying to go more into, I wouldn't say angel, but maybe angel and pre-seed, seed rounds seems to be some level of strategy that people are looking at.
Yeah, no, I think that's an interesting trend, which is what happens when all the capital starts going more upstream and it doesn't leave that much capital at your Series A and beyond. How do founders adapt, and that's sort of like a change in fundraising climate, since historically your Series A was probably the most well capitalized in the region, right? But there's always that pre-seed seed gap, or even your Series B onwards gap.
Yeah, I think that what we'll see is that a lot of the larger funds in Southeast Asia already downsized, for better or for worse. So if they previously raised very large funds during the zero interest rate policy era, I think that we will see that they will raise smaller funds, and I think it will be framed up positively as more disciplined, structured, right-sized investments for the region. I think the bearish and negative way of looking at it is like they weren't able to raise as large a fund as they could, or as they did from the LPs. Which should be a mixture of both, right? I think general partners have a good sense about where the wind is blowing, and so they're not going to go raise out a much larger fund if they don't think they can do it. And then LPs are not going to put money into a fund that's too large. So I think it's a two-way discussion. So I don't think it's either of those things, but it's more, okay, the new reality has come to perspective. Therefore, I think the next generation of VCs will be smaller than what they were historically. And I think if we do see funds emerge, we're starting to see them emerge already in the, I would say, angel round, pre-seed, seed round. I think we still see fund formation happening. And I'll say that corollary to that is a lot of them also are taking on more of a secondary approach, right? I think people looked at some of the success of the zero interest rate policy, which I think there were very few people who were like, they invested early and then they sold at one of the crazy Series A, Series B rounds that was brought in by perhaps somebody who was outside Southeast Asia, probably American, and then they secondary it out and then they made the money that way. So that feels more people seem to be replicating that strategy. But of course, the problem is everybody does that strategy. Then who's going to buy at the other end of the stick, right?
Yeah, definitely. I think there have been, I guess, call it success cases of people making money even in those crazy markets, or even in companies that have eventually bled. That's because they took secondaries off the table during one of the crazy rounds where there was massively strong investor interest both within the region and outside of the region. And I guess that's interesting because then it raises even more questions about what sort of companies can you actually do a secondary transaction down the road, which is, I guess, a question for investors to answer, especially if they want to pursue this secondary strategy. And then there's also another question, which is how do you even make that secondary transaction more seamless? Because today there's still a lot of like manual back and forth. It's probably could even be more complex than signing a safe or even converting into an SHA, SSA. So I think there's some of those process infrastructural issues to be solved as we see the rise of more and more secondary transactions in Southeast Asia.
And basically, some people can play it, but not everybody can play it, especially if you're a lead VC. I think secondary still is a pretty strong signal that you don't believe in a company. So it's difficult in general for a lead VC to do that. So we're seeing all the proliferation of party rounds, a lot of small funds banding together. That's one other approach. I think other strategies come to mind. I would say one is private debt. The one for private debt would be, if I can't make returns on equity because I don't believe so, or there's a ban of companies, can we do some kind of private capital, venture debt, or the other way is equity, but with more of a debt-like structure. So depending on your flavor of it, but the key thing is having some level of interest rate and some sort of ability to pull out the capital earlier has been also one of the things we see. So I think we see a lot of funds start to bring in private debt funds.
Yeah, I think the venture debt ecosystem has been growing, right? You have people like Genesis, Abound Capital, lending even in a downturn during this market. And I guess it makes a lot of sense for them to do that because at the end of the day, like as companies start to cut back on equity fundraising, they try to pursue more debt options in the time between rounds. But also, I think people have also started to do more like SME private credit lending. So I think Shuyin from Beacon Fund is actively exploring that space and looking for impact-linked companies that could take some private credit, and it satisfies both the impact angle but also a returns angle for the fund.
Yeah, and I think that I feel has more room to run, I would say, because I think there are a lot of companies that are being run differently. And I think if you believe that it takes more than 10 years to get to $100 billion of revenue, then it sounds like you have to do that to have that. And so I think there's a lot of companies that are like that, especially as you step outside Singapore and you look more like, say, Vietnam, Thailand, Philippines. There's a lot of companies that you can imagine becoming $100 billion of revenue, but maybe over 20 or 30 years. So I think you see your venture capital funds are still operating primarily in Singapore and Indonesia today, I would say, with a small touch in Vietnam. And then I think you see a lot more like the private debt folks are starting to explore Indonesia, Vietnam, Malaysia, Philippines to some extent, Thailand to some extent. Because also like they can't take on too much risk and they're worried about repayments, right? If they can't get the repayments in, then it doesn't work out.
I mean, let's zoom into Malaysia. I think a lot more people have been flocking there recently, and the Malaysian government seems to be making a very strong concerted effort in growing the startup ecosystem, bringing in venture funds. Personally, I've had pretty good interactions with MDAC and the MAVCAP team. How about you? What are your thoughts on the Malaysian ecosystem, especially since you have Malaysian heritage as well, right? Is this the time to go all in on Malaysia? Is that the new frontier in Southeast Asia?
When you say Malaysian heritage, it makes me laugh because I feel like every Singaporean has Malaysian heritage, right? right? So I don't think I'm very different from everybody else in Singapore. But I think what's funny is every Singaporean has been walking around Malaysia now. I have Malaysian grandparents, and I'm like, guys, because everybody is suddenly, it's hard to say if you have Thai heritage or Filipino heritage, but everybody's been walking around like that. I would say that definitely, I think Dimitri at Central Ventures wrote a report about a year ago saying that Malaysia was underexposed as a market and felt like there was a lot of good returns. Because I think this is similar to what Shiyan has talked about, right? I think that your ability to generate returns is a function of demand and supply of capital. If there's a lot of supply of capital, then the price goes quite low and then people can't get returns because there's too much supply of capital. So there's a lot of supply of capital for Singapore, because a lot of the money flew into Singapore and then they're based there and they start learning and they start looking at Singapore companies first. Also, Singapore is a high GDP per capita country, right? So obviously there's a stronger demand for capital as well because there's some good founders and deep tech needs a lot of capital. But it can't absorb all of it. And I think a lot of that capital went to Indonesia, which is a different thing, which is large market, low GDP per capita, more nascent technology ecosystem. But I think the downstream effect of that was that prices became very high effectively, or the cost of capital is very low, depending on how you look at it. Again, are you the founder or the VC? But what that meant was that it's very hard to make money if you overpaid because you're fighting against everybody else and then the returns are not so strong. Whereas I think Malaysia kind of like had a dynamic where a lot of capital kind of like, they were looking at Singapore and Indonesia, but they were looking at Malaysia because they were bearish on Malaysia. But it turns out that Malaysia has a pretty strong set of founders, right? So obviously we see that there's like Grab came from Malaysia initially. We had Qasem, which is based in Malaysia. So there's actually a whole bunch of unicorns that have come out of Malaysia because historically it has education links with the US and UK, right? And then two, it's a decent size, larger size market in Singapore. So then three, the GDP per capita is in the second tier, right? So Singapore is number one at around 80 to 90,000 GDP per capita. Malaysia and Thailand is around the middle, which is around 15 to 20,000 GDP per capita. And then you have your Vietnam, Indonesia, Philippines, which is closer to 6 to 9,000. So it felt like Malaysia is like suddenly has been discovered as the Goldilocks of not too hot, not too small, not too cold, not too large. So it's somewhere that I wouldn't say sweet spot, but it's spitting out some entrepreneurs who need capital, but that capital hasn't been saturated yet. So I think now a lot of people are like suddenly covering Malaysia. So for myself, I've always enjoyed covering, for example, Singapore, Malaysia, Philippines, because I think it made sense. That's one. Two, of course, is that everybody speaks English, so it makes it a little bit easier for me to cover those markets. And it does feel like the Indonesians have really covered the Indonesian market pretty well, right? They have all the information. And the Vietnamese are also covering the Vietnamese market pretty well as well. So to some extent, I feel if you're based in Singapore as a VC, I think Singapore, Malaysia, Philippines is an easy circuit to cover based on English and also the ecosystem permeability.
I think that classification of the different Southeast Asian markets by GDP per capita is interesting because what we have seen historically is that a lot of capital flows into Singapore, which is of tier 1 GDP per capita, and then Indonesia, Vietnam, which is I guess maybe tier 3, but very few people have actively deployed in your tier 2 GDP per capita countries like Malaysia, Taiwan. I guess maybe Open Space is one of them, and they've been very active about being early in those markets.
You can also add Brunei, I guess.
Yeah, but I guess Brunei is a whole other topic of discussion altogether, right? Like really rich, but where is it from a state of development perspective? It's the ecosystem. I actually just met someone from Brunei in Vietnam. Actually, he was a former founder and then now investor all the way in Vietnam. Are you very excited about the Vietnamese market as a Brunei person? I moved here for love, and actually I've had a lot of interesting discoveries of top tier tech talent or entrepreneurial talent that moved from good places to interesting places and vice versa because of love. And I think that's a very underrated factor for startup ecosystem development.
I mean, I don't know about ecosystem development, but that's what my mom told me, right? Who you marry is probably going to determine where you live. So I think definitely see quite a lot of American and China couples, and then they choose Singapore as a place that's relatively neutral. For both parties. We also see a lot of people who are maybe like European or American, but they married somebody from Southeast Asia. So Singapore is also a pretty good place to move to do both. And of course, I think we start to see some of the classic folks moving to Thailand or to Bali, I guess, from Eastern Europe and Russia. So yeah, interesting times.
I guess so. I think we have explored that market dynamic piece. I think another interesting trend that we are starting to see in Southeast Asia is that VCs are starting to invest more in like consumer brands, right? And I mean, these are not like consumer-focused VCs, but your sector-agnostic funds, which maybe have historically been investing in a lot more software, are now doing a lot more consumer brands, more F&B even, which has not really been considered venture backable or to be able to achieve venture scale returns. Why do you think that's happening now at this point in the market?
We also don't know whether it's true in 10 years, right? Just because everybody's investing in it now doesn't mean that it's successful in 10 years, right? I mean, I think we looked at 5 years ago, brand aggregator brands was like a no-brainer investment from many folk, and there were so many other kind of themes happen. So Warong Tech was a big one where it was about helping suppliers and the distribution chain for FMCG goods. I think the thesis around consumer, and I say this again with knowledge that I might be horribly wrong in 10 years, but I'm just saying the thesis as it stands today is that we talk about those 3 bands of GDP per capita. And so if you are at the highest band, you already have all of your consumer brands you're already buying from the US or American brands. You already have your consumer spend pocketed. And if you have 90,000 GDP per capita, then obviously you're very interested in wealth tech, right? Because you have a lot of disposable income, you have a lot of savings, you want to invest it in the stock market. I think wealth tech has been having the argument again between tier 2 and tier 3, because the problem for tier 3 is just they don't have a lot of disposable income to actually invest on the stock market as a retail investor. But maybe like your tier 2 has that ability to do so to some extent. Debatable, right? So I think the argument, the converse of that is that instead of saving, every dollar of growth at the tier 3 probably goes into consumption. So I think the argument is if your GDP per capita is 6,000, 7,000, 8,000, most of these governments at this band have been promising like around 5 to 6% GDP per growth. So that means that your economy will double across 15 years. So what that means is if your economy is about 7,000 GDP per capita, then if it doubles, then it goes to about 14,000 GDP per capita in 15 years. So across those 15 years, are you going to spend that in the stock market? The argument now today would be like, maybe not, because you'd rather spend it on, and you kind of talked about it, right? We just rather buy it in either housing, education, or consumption. Housing because people want a shelter, they don't want to be renting. People have a strong ownership mindset, so they want to buy land, buy housing. Education because I have kids, I still have kids, I want them to have a better life than me. And then lastly is consumption, right? So it'd be like entertainment to all kinds of things, right? So I think that's the way I think people think about consumption is, people are just going to party more.
Interesting. And from a venture scale return perspective, how do you think about that?
That's the problem, right? Theoretically, it makes sense, right? I mean, if you believe that in 15 years, people are going to double the spend on that, let's say category, the question of what it is, right? And then you're in a market like Indonesia, which is almost 300 million people, then you're basically saying, okay, everybody's making this amount of money. What category is everybody now going to spend $1,000 on? Then you're like, okay, I can make the math work, right? 100,000 people, so 1/3 of the population is now a consumer of this new thing, which is $1,000. And that comes out to maybe about $100 a month. So maybe it's what? A laptop? I don't know, I'm just giving an example, right? $1,000 could be a laptop or tablet. You can say everybody wants to buy a laptop. Probably, of course, I think people are more likely to say like they're probably going to buy a nicer phone actually rather than a laptop, right? So smartphones is a hot category. So we're seeing a lot of these like smartphone retail startups that are trying to make some promise around helping people access smartphones. So I mean, I think there's a debate, right? I think there's like consumer brands like food, heritage brands. We talked about it, right? If we could buy Bengawan Solo in Singapore.
I would love to buy an old Bengawan Solo.
Like some heritage brand, it has that batik pattern, it's got like consumption pattern, it's got gifting. I mean, it goes back to what we talked about, it's like TWGT, Baka Coffee. So both of these now belong to Osin Group, which is the group that makes massage chairs. So people are like, oh, people really like that super luxe royal style. People find it tacky in the US. Oh, it's so much marble and gold kind of style. It's like the Versailles French style that they have, Baroque. And then it turns out if you had this GDP per capita, like that is definitely what the next band looks like in terms of luxury. So I guess the crux of consumer is it's probably luxury to the most of the current mass consumer today, but you believe will become the mass premium in 15 years, right?
And I guess from a market perspective, a lot of people feel that Indonesia, Philippines are highly consumer-driven markets, and that probably makes sense to make some consumer bets compared to maybe, say, Vietnam or Malaysia. Do you agree with that sort of like classification?
I mean, I think people often have that debate, which is like, in general, there are cultural differences in society about whether you want to save more or you want to consume more. And then the corollary to that is, do you want to save more or consume more? But the other one is, do you borrow more? And I think we've definitely heard that from startup founders articulating that as part of their pitch. So some people may say something like, we want to do a wealth tech in Vietnam because Vietnamese people really want to invest more in housing or the stock. I wouldn't say stock market, but in housing. Therefore, we help them get fractional ownership or some equivalent of it. So I think definitely, you hear that a lot in the pitches. I do think it's a factor, but I just don't know how much it is a factor compared to GDP per capita and the growth rate of the economy, right? So I just think that if your GDP per capita is 90,000 in Singapore and the government forces you to save 30% of your income, then of course, there's a lot of capital available to save and therefore invest in housing or the stock market. Whereas obviously if your GDP per capita is like 5,000, then how much money can they actually put to work even if they have a propensity to save? So I would say that GDP per capita and the growth rate of countries is probably a much higher factor, I would say, than compared to some cultural attitude. I mean, if you think about the OECD, if you really think about it, maybe you look at Japan versus America. I guess most people look at that as two ends of the scale, right? And maybe China is also somewhere in there as well. So China, Japan are much more likely to save, and then American households. But of course, again, Japan is much more similar to America, I would say. China is obviously, I think people forget that it's still like an order of magnitude lower GDP per capita compared to the US as well. I mean, who doesn't like free money to spend, right? So people like to borrow. So I think it's also to some extent maybe even more government driven really than cultural driven. I feel you really asked me about it. I don't feel like the American way of life is very debt driven. If you look at it historically, like 100 years ago, America didn't use that much debt. Yep. Even 50 years ago, it really didn't use that much debt, if you think about it. It's only in the past 50 years. So I think it's a mixture of like policy and lending opportunity. But of course, I think debt is always amazing, right? Because debt makes you feel like you save more. It makes you feel like you can get to spend more. And of course, you have to pay back eventually, but that's in the future.
Yeah, and I guess there's a lot of, someone shared with me this before, they were giving out revolving credit lines to SMEs, and their SME like customer base has been pretty good from a monthly repayments perspective. But then when they had to downsize their overall credit facility and consequently downsize the individual credit facilities to the SME, suddenly a lot of these guys weren't able to pay back. So I think there is some understated over leverage in certain parts of the economy.
Yeah, I mean, that's pretty much true of, you can imagine almost every lending facility, right? Even countries have that issue. Can you imagine how many countries can pay back the principal? Japan and the US have huge amount of debt versus GDP ratio. And I don't think they could pay back the principal easily anyway, either. But of course, I mean, there's a dream of everything is can you pay back that coupon over the next 50 to 100 years? So, you make a lot of money off the interest rates. So I think that's one of the ways people are doing it is like trying to do more lending. I think we're describing an interlink, right? I think one is VC approach is doing more lending. And then the second aspect, of course, is doing more consumer. And of course, one interlink is that there's this aspect of consumer finance, which is a function of like debt vehicles cascading through the system, which gets deployed in more debt towards consumers. So there is some interlinkage, but I would say that these are two different response strategies from a VC or investor perspective. I think the last adaptation strategy I have is either build better or invest more strictly. I think they're two sides of the same coin, but not exactly the same, right? Building better is basically saying founders, maybe because they listen to this podcast or they fundraise a lot and they keep running into a brick wall, start to kind of like process and say, okay, I can't raise money that easily anymore. So I think all the founders, I mean, this is old news, right? Have been downsizing, doing layoffs, becoming much more efficient about capital, prioritizing their growth initiatives much more. So building better, but also being much more realistic about stuff that was obvious to some people. So we talked about it before, right? SaaS in Indonesia is difficult because the GDP per capita is so low. Therefore, it's easier for you to hire 5 people to take on that problem rather than install SaaS, for example. So I think you see a lot of SaaS founders being much more disciplined, I would say, about their market expansion as well. There's a bunch of doing better stuff. And then I'll say the corollary to that is like investors investing more strictly. So it means that they are probably using more disqualification criteria. So if your strategy is bad, they probably disqualify you faster or earlier. And then if they do join the board, I think they're trying to be a lot more disciplined. So they're trying to be like, okay, let's focus more on growth profitably, or let's not do this market. So I think there's some Darwinian response where VCs who are not investing strictly or not being good board members or being a board member and coming in with an investment thesis that's wrong and therefore exploding the startups in a negative way tend to get weeded out. And so you see, I think, VC departures from the VC scene. And then on the other side, so you see founders who are either winding down because they couldn't execute in time. And then the founders who are left are just more disciplined as a remaining cohort.
Cool. I think we have covered a lot of ground talking through some of the differences in vintages and also the differences in DPI across vintages, and consequently how some of the investors across the region are responding to the market correction we see. We see people investing in consumer, we see people exploring new frontier geographies like Australia, New Zealand, India. We see people doing more interesting structuring of deals like lending, etc. Yeah, it's been really great doing this morning breakfast show with you, Jeremy.
Yeah, awesome. All right, peace out.
Peace out.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.